Dear investment gurus, we are going to continue our discussion of the value line, one of the most respected and trusted sources of data and analysis, and learn how to use it for the models that we've created in our previous presentations. Traditionally, the value line was often the only source many investors used for data analysis, along with the company's materials, of course, the 10Ks and the 10Qs, the annual reports, the quarterly reports, and we'll discuss and work with the financial statements in our next chapter. The value line is expensive, folks. It's $600 a year, but there are various levels, but the most widely used one is the $50 a month one, but that's why there are libraries. And there are various libraries in San Diego that have this that you can go to. And there are a couple libraries that actually offer some of the material online. And then the value line used to be totally fee-based, but they have adopted what's called the freemium model. You know what Morningstar and MarketWatch and Yahoo are doing. They'll give you some information for free, and then they want you to sign up for one of their subscription services for all or more information. Personally, I'm a big fan of the value line, especially their timeliness, safety indicators, and the 3 to 5 year price appreciation prediction. Very cool. One study, which ignored transaction costs and tax consequences, only used their timeliness indicator. Now they have 1 through 5, and if timeliness is 1, that means they think it's going to do well, and then 5 means they don't think it's going to do well at all. It showed how you would have beaten the market handsomely over a 20-year period just by buying and selling stocks as they received and then subsequently lost their number 1 timeliness designation. Now, again, that's the past. It doesn't mean it's going to be that way in the future, but it shows that they have a pretty darn good track record. So let's take a look at the SIP from the financial fire hose. We're going to look at the indicators, the future price projections, the historical data, the cash assets, receivables, inventories, the description analysis of the business, the historical annual rates, the predictions for the coming annual rates, the insider and institutional buying, the amount of debt, the number of shares, the company's financial strength, the stability, price growth, earnings predictability. Oh my goodness! This is indeed a sip from the financial fire hose. Now, we can't put this in the accompanying textbook. But my understanding, and I might be screwing this up, I don't know, is that we can use it in a class. There's an educational legal entity thing called fair use rule. And if I'm getting it wrong, value line, I apologize. I'll take it down. My apologies. But we can show it to you in class, but we can't, put it in the book. So, however, we talked with the value line, and they said that if we get a subscription, which we're trying to do right now, we put in a grant, Southwestern Community College, and if we get a subscription, you'll be able to use it in the library and online, only up to 3 people at a time, but most people, not that many people using it at a time, and we'll be able to put it in the textbook. At least that's what they told us, so we'll figure it out eventually. So here it is, folks. This is the top page. Now, what they've done lately, this is what they used to give you, is just the sheets, and that's what you'll get if you go to the library. But now they've turned the sheets into the website, and so I'm still kind of stuck on the sheets. That's what I use, but I've been trying to use the website more and more because it's got more bells and whistles. But I barely use, 5% of what they give you here. Now, notice it's showing you the Johnson & Johnson, and this one is for the 11th of February, 2022. They come out with 4 a year for 1,700 stocks in their regular $50 a month one. The $20 a month one gives you 600 stocks. You can get the Dow Jones 30 stocks for free. That's part of the freemium model. So Johnson & Johnson is a Dow Jones Industrial Average stock, so this one you can download on your own. And notice, look at this. Look at what the value line is telling us. Remember in our discounted cash flow model, we said, what's the stock going to be worth in 3, 4, 5 years? The value line is giving us what they believe is a range of the stock's future price in 3 or 4 or 5 years. And I got to tell you, folks, they're pretty darn good. They're not perfect. They'll tell you, first of all, they give you a range because they don't know exactly what it's going to be, but they tell you what the price projections are for the next, 3, 4, 5 years. And they're usually pretty darn good. And they also keep track of the sales, the cash flow, the earnings, the dividends. Remember, the dividend discount model wants to know how the dividends have been growing, and we can see them growing. And we're going to use this data, this historical data, in our model. But notice that it's just a tiny piece of the puzzle. There's so much more information: the sales, the operating, the depreciation. We'll discuss that net profit next chapter. The capital structure: how much debt, how much equity, how much of the company does the company own, how much does it owe? The institutional decisions: who's buying and who's selling, and then the next page, and this is the notice that it tells you, hey, there was a recession here. How did it hold up during a recession? It went down, of course, like everybody else, but it held up pretty darn well in the recession. And then the next page is the bottom, which gives us cash assets, receivables, inventory. We'll discuss those later on. Notice the annual rates for sales, cash flow, earnings, dividends, book value for the past 10 years, the past 5 years, and then their predictions for the next 3 to 4 to 5 years. Very cool. Their sales, their earnings per share, their dividends, the description of the business. And then this is so important, dear students, especially this very last paragraph. But they describe what's going on with the company. What's the report? What's the business report? And I love to read this very last paragraph, because this is where they usually tell you whether they think it's a stinker or not. And they do it in really coded wording. They don't always say buy this or don't buy this. These shares are neutrally ranked for timeliness, which means in the next 12 months, 16 months, 18 months, they're not too excited. But they offer below average 3 to 5 year price appreciation potential. So you go, well, that's not exciting. But that said, prospects are better on a risk-adjusted total return basis. What are they saying? In other words, yeah, Johnson & Johnson isn't going to shoot the lights out, isn't going to zoom to the moon. But at the same time, if you're interested in not losing the money, they are a better prospect on a risk-adjusted total return basis. Investors should note, and also this is something coming up, and Johnson & Johnson has decided to break into 2 companies, which is typically, when a company does this on their own, not being forced by somebody or trying some outside corporate raider, it's usually a good sign that both entities, or at least one entity, is going to, they say, unlock the value that is there. So we'll see. That's part of the uncertainty that's involved in investing. And they say the same thing. The split is expected to be completed within the next 2 years. The move should aid growth at both new businesses, but there is obviously some risk with a move of this magnitude. But typically when a company does that, like we talked about Abbott in our previous Abbott Labs and AbbVie, both companies, or at least one, is both companies are poised for further growth, independent of one another. For whatever reasons. And of course, this is just the beginning. We've got to read everything we can. We've got to, look up their competitors and read everything we can about them, and look at the market as a whole. And remember that Johnson & Johnson is a global company, and that's why mutual funds have entire teams of analysts all around the world, and we only see the tip of the iceberg. Oh well. But it definitely is an asset that helps us tilt the odds in our favor toward companies that will do well, not maybe make us rich quickly, but we don't have to win big. We just have to win over the long term. Make us rich slowly, build wealth slowly. So as we said, slide 41, it's a sip from the financial fire hose. Interspersed among the mountain of data, did you notice the highlighted historical dividends, the future stock price predictions, and the predicted dividend growth? And we talked about the other models that use sales and earnings and cash flow and profit margins. So you would then key on that data using those models. Did you read the company analysis? Personally, your humble instructor does not make any decisions about individual stocks without consulting the value line. That doesn't mean just because they say to buy it or not buy it, I don't do that. But I definitely personally think that they're a very good source to use. And there are others. Morningstar is now trying to jump into their cookie jar. For many years, S&P, Standard & Poor's, had their own, I think they basically were a ripoff of Value Line, and I don't think they were very good. And now they've split that off, and now it's another company. There are others, folks. I'm not trying to say this is the only one. There are others, so check out the others. Let's take a look at the spreadsheet that we're now going to use. We're going to use the data from Value Line to quickly calculate the Gordon growth model and the discounted cash flow model. So you can click on that, but I already have it up and running. So here it is, and it's on the website. So here it is, the Value Line Johnson & Johnson spreadsheet. And so notice the areas that are highlighted or shaded. That's the only place you put data in, right? You put the year, and then it calculates the next year's. And then you enter the historical data for the last, I use 7 years. They use 5 and 10. I use 7. I don't know why. You decide. The previous years. You decide how many you want to use. And then the rest is done by the spreadsheet. What it does then is it calculates the growth between each individual year of the dividends. So between 2016 and 2017, it grew 5.4%. Between 2017 and 2018, it grew 6.63%. Remember, this is the data from the highlighted area that we showed you on the value line. So that's where you get the data from. And then it calculates the yearly dividend growth rates and then calculates the average dividend growth rate. So that's going to be our prediction for the future. They've been growing their dividend for the last 7 years at 5.81%. Now, we'll also utilize Value Line's prediction, 6.5%. And if you don't believe me, go back, stop the presentation, go back and take a look at the Value Line, or download it for free because it's one of the Dow Jones Industrial Average stocks. And there's a presentation that shows you how to do that. And so we're going to use both our computed average of the last 7 years and also their prediction for the next 5 years. We enter the current price, and then the predicted price is, again, something we grabbed from Value Line. Why don't we go back? Why don't we go back and just take a look, review this data again? So remember, they predict the price to be anywhere between what? 210 and 255. So about 210 and 255. So we use 225. And then here's where we got the data for the dividends for the last 7 years, going back all the way back. And then the next page, here is the predicted dividend growth for the next 3, 4, 5 years, 6.5%. So this is where we got the data, just a tiny little bit of the data from the Value Line. And that's, as you learn more models, you'll use more data and the like. And so after we enter the dividends for the last 7 years, and then the current price, the predicted price that we choose, that's a lot of that is just judgment that you learn how to. I always go lower. I don't go at the top. I usually go at the lower end. And then what Value Line thinks the dividends are going to grow at, 6.5, and what we calculated. And then the spreadsheet does the rest. It then shows you the Gordon growth model. And let's go back to the actual spreadsheet. So it shows you the Gordon growth model. And then it shows you the discounted cash flow models using both our dividend growth rate, the one we calculated for the last 7 years, and then Value Line's predicted growth rate. And then it does the internal rate of return. So all this is done for you, folks. You don't have to type in any more than what was in the shaded areas. Let's go back to the presentation. So the first one says using the Gordon growth rate, using our calculated 5.81% dividend growth, and then the Value Line's predicted growth rate of 6.5. And you'll see at 12%, not so good. At 10%, not too bad. It was selling 25th of February 2022 for $166, and our models say $111, $130, so not so great. But as soon as we say, look, this is Johnson & Johnson. If we get 7, 8%, we're really happy. The model is saying, yeah, no problem. We can reasonably expect it. If what happens, you believe what happens. Now, we don't know if that's going to happen. In fact, we do know it's going to split in two, so we're going to have to do this all over again for the two different companies. Because if we did buy Johnson & Johnson and then the company split, we're going to get both stocks. We're going to get some stocks of the one company and some stocks of the other company. So you notice that this is an ongoing thing. We're continually doing this with the companies that we own and companies that we're thinking about buying. So can we reasonably expect 7, 8, 9% from a company like Johnson & Johnson? I think yes. We don't know. That's why they call it the future. Notice how our choice of required rate of return, the discount rate, changes the prediction results drastically, dramatically. And so now here is the same spreadsheet, but now we're just showing you the discounted cash flow parts using our dividend growth rate and the value lines predicted 6.5%. Our computer was 5.81%. And notice here's 10% using the present value multipliers for 10% and using the present value multipliers for 8%. Notice at 10%, pretty darn good. About 100, well, the price was $166, and using our growth rate and both ours and value lines. Notice they're very close to one another, 5.81% and 6.5%, close to one another. It's saying that, yeah, you should probably get 10%. And if we go down to 8%, it's saying, yeah, it's a very good buy. At $166, we think it's worth about $181. Here we calculated predictions from the discounted cash flow model using both the average dividend growth rate of 5.81% over the past several years and the value lines predicted dividend growth rate of 6.5%. They yield very similar results. And then lastly, the internal rate of return, done for us. We don't have to do anything. The internal rate of return uses both the average dividend growth rate and the value lines predicted dividend growth rate. So here's the one where we put in we use 5.81% or 6.5%. And notice that they give us similar results. They say, if this happens, which we don't know it's going to happen, but if we lowball, which we did, value line said from 210 to 260 or so, and we took 225. If we get that, if that's what happens with the stock, and remember, it's all going to change anyway, but if this is what we get into the future, we're going to get 10.5%, which again, with a company like Johnson & Johnson, been around for over 130, 40 years, that's pretty darn good, in my humble opinion, assuming the world doesn't blow up and we all die of who knows what radiation poisoning. Would you consider owning Johnson & Johnson? You ever use Q-tips or Band-Aids or Tylenol? And maybe you've gotten their one-dose COVID-19 virus. I mean, vaccine, sorry. You got the virus vaccine from Johnson & Johnson. It's a big company, folks. It's been around for decades and should do well into the future, but no guarantees. You know that part already. Cool. I think it's pretty cool, but you're thinking, Payano, please, do we have to use this spreadsheet? It's so confusing. Look, we promised you that you could perform all the calculations in this course using a 99-cent calculator, and we've kept that promise. You don't have to use the spreadsheets. You can do all these calculations manually, but wouldn't you rather bang away at the spreadsheet until you figure out how to use it? Like I said, it's like a big bingo game, bingo board. You just move around and put the data in the shaded areas. The rest are formulas, and you can try to figure out the formulas if you want. The real prize here is that all we need do is consult the value line for our data to use in our spreadsheets or our manual calculations. And that doesn't mean we should use them as gospel word. We use them as a starting point, and our judgment as we move through this world of investments, our judgment tells us that's a little bit too optimistic. I'm going to stay on the bottom end. Or, you know what? I think they're too pessimistic. I'm going to be even higher. And that's what Benjamin Graham said. He said you got to use human judgment. You can't take human judgment out of the equation. So we use these numbers to get us started, and then we use our experience and our judgment to hone them, realizing that it's all going to be off the mark anyway. We're just doing this to tilt the odds in our favor. I think I've told you that already. Are you excited? Are you ready? Good, because it's your turn. It's your turn. Find a library near you that has the value line, or go online and use one of the 30 Dow Jones Industrial Average stocks for free. Before you go, though, think of a few companies that you would like to research. Maybe downloading their annual reports from the websites beforehand. Ask the reference librarian for the value line packages, and it's this huge, it depends on how they have it together. Sometimes they have it in one big, huge 3-ring binder, which is hard to handle. Usually they put it in packets. Find the index of the companies, that's in the first. The companies are in alphabetical order. You look up the company and it tells you which packet it's in, and then you go to the packet, and the cool thing is Value Line groups the competitors close to one another. So if you looked up FedEx, UPS would be right next door. Right? If you looked up GM, Ford, and Honda, and they'll all be there. Get lost in a nice way. Have fun. Everyone's different, and my wife is a voracious reader of historical novels, and so we go to the library, and she's finding 4 or 5 or whatever historical novels, and I take out the value line and start pouring through some of the companies I'm interested in. And that's a fun afternoon for the two of us. But I'll tell you, it's pretty easy to download it too. I'm getting hooked on this downloading these things. I get a kick when some speculators, some traders, trash the value line. They make mistakes too. Value line makes mistakes, just like everybody else. But I sure would love to see how those traders' long-term results stack up against the long-term results of the value line. Who do you think can have the better results? Long-term. In the short term, the traders might go way ahead or they might go way below because they're gambling. Ooh, we don't use that. Speculating gambling. Okay. Oh, wow. Has this been a sip from the financial fire hose? I think so. But let's take a look at the bottom line. Okay. Once we have finished all our valuation calculations, what should we do? Should we really place much value in our predictions? No, 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 no. We know going into this, we know that these predictions are just seeing which way the wind blows. Rather, after we've done all our calculations, we should hurl them into the vast ocean along with the ashes of our dead pets and relatives, or shred them into millions of tiny little pieces of paper and use them as confetti at our next party, or burn them in a huge bonfire as we dance naked under the full moon. Now there's an image for you. Or all three! Throw them away! We do these calculations to simply tilt the odds in our favor for long-term, prudent investing and preservation of capital. How's that for a fancy way of saying don't lose the money? Instead of placing any significance in our predictions, after we've finished, we should ignore them. Ask ourselves some very simple questions. Do I want to partner with this company? Do I want to own this company? Do I believe this company will succeed? What is the business model? Yes, I know. It doesn't give you a definitive answer, does it? You were looking for something that would say, ha, here's the number I want. This is what I'm going to do. Wrong. Peter Lynch, this is, I think, a a really cute thing that Peter Lynch would do. And you're in his book, One Up on Wall Street, which you're going to read eventually, right? It's one of the best books to read, for the first books to read apart after you've taken this class or during while you're taking this class. He said, after he did all his, this is before the internet, folks. This is before the internet, microcomputers, what we used to call microcomputers, PCs, laptops. They were still in their infancy. He would put everything in a 3-ring binder, all the clippings from the newspapers and the like, and all his calculations. And then he would hold it up in front of himself. And he would say, okay, this is Nike. I am buying Nike because they are the premier sports, whatever you want to call it, tennis shoe creator. And they've got all these things going on. And or I'm selling Nike because of this reason, this reason. He would give himself the 30, 60, 90-second pep talk about why he should sell or buy or hold. And then after he was done with that pep talk that he gave himself, he usually understood. He usually knew what he was going to do. Warren Buffett says, look, would you want to own this business? If it were a shoe shop or a pizza shop or another business sitting on the corner, would you want to own it? If you could own FedEx, if you could own the entire company, and you would, go ahead and buy 10 shares. Now, that's how much we can pay. He buys the whole company. He owns, well, Berkshire Hathaway owns Geico and owns Dairy Queen and owns See's Candy. And they own, what else do they own? Burlington Northern Railroad. I mean, so he buys the whole company. So we will finish with a quote from a gentleman who wrote a book that's out of print, which is very sad, and they really should bring it back. And it's interesting. This book now has become like gold. It's gone up like $500 a copy or $1,000 a copy. The problem is Seth Kleiman, at the margin of safety. The problem is that it is easy to confuse the capability to make precise forecasts with the ability to make accurate ones. Any attempt to value businesses with precision will yield values that are precisely inaccurate. We know beforehand that as we make these calculations, there is a 99.99% chance that they're not going to be right. They're going to be inaccurate. So why do we perform them? These calculations help us identify companies that are prudent, long-term oriented investments. They won't make us wealthy quickly, but they should, unless the world ends, make us wealthy. To quote a very wise client of mine, after I had discussed my investment philosophy, and I thought of slow and steady, whatever you want to call it, prudent long-term investing, buy and hold. He said, "Look, I don't have to win big. I just have to win." And it struck the back of my brain and has been burned there ever since. We don't have to win big. When you hear, look at this, it's done. Okay, fine. Go look at GoPro, or look at some of the other companies that have skyrocketed up and then fallen down. Of course, you're going to hear from other people who are not as conservative, and has nothing to do with politics, not as conservative as I am. They are more growth oriented, and that's fine as long as you understand the risks and potential rewards. That's all we want. We want you to have your eyes wide open. And that, dear students, is our discussion of valuation models. You are now official investment gurus. You look past the price and the hype that people are talking about the companies, and you're going to then dig deep into the valuation and look for the intrinsic value given your required or desired or expected rate of return. Cool. I'm so proud of you. I'm so proud of you. It's time for a breather. But in our next chapter, we're going to continue with fundamental analysis and start to dig into the annual reports and the quarterly reports, specifically the financial statements. Now, you accounting students, relax. Don't worry. We don't create the financial statements. We're not going to do journal entries and trial balances. No. Don't worry. We just grab them off the internet and use them in our calculations. See you in our next chapter when we begin financial statements and ratio analysis. I'm so proud of you.